Hello guys, welcome back to Study FX channel. On this channel, it's about forex trading, binary trading, and crypto trading. If you're new here, welcome, and if you're returning subscriber, thank you for always coming back to watch my videos. So guys, on today's video, I'm going to teach you different types of forex order. So make sure you watch the video until the end so that you can learn. So forex order are instruction given to your brokers to buy or sell a currency pairs. Understanding the different types of order is crucial for effective trades. Here are the main types of forex order. The first one we have here, it's the market order. A market order is executed immediately at the current market price. Traders use these types of order when they want to enter or exit a position quickly. The next type of order that we have here, it's the limit order. A limit order allows trader to set a specific price at which they want to buy or sell a currency. The pair to sell a currency pair, the order will only be executed at the specific price or better. So example we have here, you want to buy GBP USD, but you believe the price will drop to 1.2510. You set a limit order at 1.2510. If the price reaches this level, your order will be executed. So stop loss order is designed to limit an investor's loss on a position. It automatically sells the currency pair when it reaches a certain price level. So example, you bought USD JPY at 110. To limit your potential loss, you place a stop loss order at 109.50. If the price drops to 109.50, the order will trigger and your position will be closed. So the next thing that we need to know here, it's the take profit order. A take profit order is used to lock in profit when the market reaches a specific price level. It automatically closes your position to secure gains. After buying, let's say you are buying USD at 0.7,000, you set a take profit at 0.7200. If the market price reaches 0.72, your position will close, securing a profit. So the next one that we have here is the stop order. A stop order, also known as stop entry order, is used to enter a trade once the price reaches a specific level. This type of order can be used to capture upward or downward momentum. The next one that we have here is the trailing stop order or stop loss. A trading stop order is a type of stop loss order that moves with the market price. It allows traders to continue securing profits while protecting against potential losses. So if you buy NZUSD at 0.6500 and you set a trailing stop loss of 50 pips, if the price rises to 0.6550, your stop loss will automatically adjust to 6500. If the price then drops back to 0.6500, your position will close, locking in a profit. So the next type of order is once one cancels other, OCO order. An OCO order combines two orders where the execution of one cancels the other. This is useful for managing risk and locking in profits. So example, you have a long position in USD CAD at 1S2500. You place an OCO order with a take profit limit at 2700 and a stop loss at 2400. If the price hits 1.2700, the take profit executes and cancels the stop loss order. If it drops to 1.2400, the stop loss order executes and cancels the take profit. Understanding this type of order is essential for effective trading strategies. Each order type serves a different, whether it's to enter a trade, limit losses, or secure profit. Using them effectively can help you manage risk and make more informed trading decisions.